The 30-year yield came within reach of hitting an 18-year high earlier, touching about 513. It's about 506 right now. While it's a concern for the broader market, there are ways to take advantage of it. Jeff Kilburg has some ideas about that. He's CEO of KKM Financial and a CNBC contributor. I'm trying to think of how do you take advantage of rising rates in the stock market. Jeff, welcome.
Well, you have to lean into it a little bit, Kelly, right?
I guess. Do tell.
Well, I think it's interesting because right now, and I go back to my experience where I cut my teeth, as you know, in the bond pits in Chicago, the Chicago Board of Trade, now CME Group. And what the bond market is providing, which is always leadership in my opinion, but what it's seeing right now at this higher elevation, it's not screaming we have a problem, but it's also telling the government, as you look to roll all these maturing debts, it's about 7, 8, if you talk about the deficit, maybe $10 trillion this year, we want more. We want a higher VIG for what we're taking the risk on. So I don't think it's alarming. I think equities have the ability to move higher with this higher interest rates, but I think we just become conditioned, Kelly. Remember that old acronym, NIRP, negative interest rate policy?
Oh, yeah. ZIRP,
We've
yeah.
kind of come out of that so far. So I'm okay with where the 10-year is. I like to see it back under 450, but there are a couple stocks I think you can own as you kind of lean into this higher interest rate environment.
As I skim through the list here now, I would go, oh, okay, the financials and Berkshire, and that's a clever one. So just talk us through this.
Well, Berkshire, I actually have two I'll kind of tuck together here. So if you talk about American Express and Berkshire, Berkshire happens to own 21% of American Express, but I think the financials, you see the strength of the consumer, and therefore American Express specifically, as they continue to expand, they actually just printed 3.4 million new cards in Q1 of 2025, and as their international expansion of more than 130 countries, that should allow them, that higher end, that bigger brand consumer, to continue to spend. But Berkshire, they're going to make more money on these higher interest rates. Why, Kelly? Well, they have $348 billion sitting in short-term treasuries. And if you look at that front end of the curve, you know, it's not far away from that 1 month, 3 month bill. It's pretty close to the 10-year note. So a 4% return on all that cash is going to make Berkshire a continued name that we own. We actually own in the Essential 40 ETF because we believe that diversification, that financial tilt that Berkshire has, that's going to prevail in raising rates.
Explain ServiceNow.
So that's a counterintuitive one, right? And you're saying, what are you doing here, Killer? This is a growth name, but it's also value. And yes, it's been on a 1 month run up about 34%. But I think this is more of a situation where if you're looking at companies, are they going to be borrowing more money to be spending with these higher interest rates? I think the answer is no. So if you look at a ServiceNow, which is true workflow automation, that is possibly a less expensive step to make more efficiencies in your company. You don't want to borrow that big money to make that big capital expenditure, but ServiceNow, which has a ton of momentum on a chart as well, Kelly, has the ability to bring in more customers as we look for efficiency and workflow automation.